Hi everyone, this is Rob Roy and welcome to this edition of the Elliott Wave Options U.S. Market Update. Before we get started, if you like these videos, if you find them informative, please give us a like, subscribe if you'd be interested. Holy cow, what a couple days we've had in the markets. I'm calling this the yin and the yang of the markets. Most people think of yin and yang as opposing forces with that diagram that you see, but actually yin and yang are complementary forces, and in general terms it means that the sum is greater than the parts, so the whole is greater than the parts. And I think you'll see what I mean by that after a little bit of commentary here. But yesterday we had the Federal Reserve come out, cut 25 basis points, exactly what the market was expecting, but the market sells off after the announcement was made when they went to the press conference. And now it seems like every meeting has a press conference, where in the past under Greenspan you might get 2 press conferences per year, but they like being in front of the microphone. Now maybe Chairman Powell doesn't like it so much anymore because he's been taking an awful lot of heat lately, but he came out and kind of hinted that it was a one and done. And that's not what the market was looking for. The market has been pricing in 2, possibly 3 rate cuts, and with that hint, the market sold off big. The market was basically just flat after the 25 basis point announcement, the cut, because that was what was expected. They didn't get 50, but what was expected came out. But then he makes that comment and the market tanked, and everybody criticized him, including the president. So the president's out, the Federal Reserve isn't helping me, and he should have said that we're embarking on an easing cycle, which is really what the market wanted to hear, not just a one and done. So everybody was on Powell for the way that press conference came out and the terminology that was used. Well, then this morning he comes out and says, well, I didn't mean to say that it was only one and done. I wasn't committing to that. We'll see how the data goes. He softened the stance quite a bit. Market started a little bit to the upside, and by midday had rallied back basically everything that it had given back on Wednesday. And then President Trump comes out and says he's imposing more tariffs on China, and the market tanks again. So that seemed a tiny bit hypocritical maybe of the president to criticize Chairman Powell somehow. Listen, I'm not defending the Federal Reserve. If anybody's ever heard me give a live seminar, there's nobody more critical of the Federal Reserve around than I am. But just the fact that he was criticizing Chairman Powell for knocking the markets down, and then the markets rally back, and then he comes out with some news the very next day, which knocks the markets down. So he says, well, in the end, everybody knows what we're doing with China, and that's understandable. China's economic data has been really bad. The president wants to get this trade deal done. I think he saw an opportunity to press the bets a little bit, if you will, tighten the screws, whatever analogy you want to use, on China and pressure them further into getting this trade deal done, because he wants to get this done. And that's where that yin-yang thing comes in. The sum is greater than the parts, so the whole is greater than the parts. Looking at the whole picture down the road of, even though the market sold off hard today, if it works, if the pressure does bring China more seriously to the table to get the deal done that the U.S. wants, then obviously that would be a huge rallying point for the market. And then the same thing with the Federal Reserve. Cutting 25 basis points when the economic data hasn't been that bad, that's really pretty accommodative, but they had backed themselves into a corner. They pretty much had said that they were going to do it, and then the data came in better than most people had been forecasting. So even though 25 basis points, if that's all it is, and we don't get any more, might be slightly disappointing, in the end, if we don't get any more rate cuts, that means the economy's doing well, right? And the economy's doing better than expected, and the market should respond to that accordingly. So again, another example of the whole being, greater than the parts, that the 25 basis point rate cut's just part of it. Look at the whole picture. If they don't cut anymore, then it's because the economy's doing great. If they do cut, great, because the market's addicted to that liquidity heroin anyway. So all that stuff is what's playing out in the market. So I'll shut up now, and we'll take a look at the charts and see what's happening with the market with all of this craziness over the last couple of days. Let's take a look. So here's a chart of the S&P, and one of the most important things to look at is two things here actually that are important to look at in my opinion. If we put the moving averages on here, you can see that when the move to the downside, we are now at the 50-day moving average, so no harm, no foul yet. Holding that 50-day moving average would be important. And then the other thing to look at is where we are with these most recent highs, and we certainly don't want to meaningfully close below those highs. So we want to hold right in this area from that standpoint too. So two things converging here, basically where we were on the close of the lows of the day today, and we'll see how that plays out. We haven't quite reached our wave 5 target. I still just have the feeling that we need more upside before a significant sell-off, but the market can break, technicals can break, and if we get too much of this unexpected news-driven stuff to come out, then once the charts break down, then it's Katie bar the door. There's a lot of technical traders out there. There's a lot of automated trading that follows along with the technicals like what we show you. And so just because of the theory of the shorts wanting to have more retail traders in there, if they don't get that opportunity, they don't get it. So we'll have to see how that plays out. But I wanted to show you that where we are right now is a very important level to try to hold. Even if we consolidate here from a technical standpoint, we don't want to break down much from here. Thought we would look because these are the things that are interesting to look at with the Federal Reserve right now. Is the dollar. The dollar has been flying. It's in a wave 3 to the upside. And if you've been listening to any of the recordings I've been talking about, everybody's been talking about, really not just me, is the fact that it seems like countries around the globe are in a race to devalue their currency because it makes servicing the debt easier and makes trade easier. All of those things are beneficial when your currency is lower. And the Federal Reserve, with their hint yesterday that they weren't going to cut anymore, caused a spike in the dollar. You can see that big spike move that occurred there yesterday, and then we were up earlier this morning and then came back down when the Federal Reserve Chairman came out and said, hey, I wasn't trying to hint that it was only going to be a one and done, and so it came back a little bit, but we're on a pretty good run here with the dollar. In fact, we're overbought currently right now. Even with the close here, we're still a little bit overbought from the 10-day moving average. Remember the rule, no security in any time frame gets very far away from its 10-day moving average. So we've got this pretty strong move in the dollar, which is not good long term for the economy, even though you do want your currency to be viewed as strong. So that's a catch-22 that's in there. But when you have the kind of debt that we have in the U.S., it matters in servicing the debt. So let's take the moving averages off, and then we'll take a look here at this pullback. I wanted to show you this. We had this big impulse move right here, and that was followed with a perfect, look at that, perfect 50% corrective move in this zigzag pattern. That then yields an expected target of a 100% fib extension target in the dollar. And we're not quite there yet. And isn't that interesting that the 100% extension in the current zigzag pattern right here, that's the C wave, corresponds with where we are in the wave 5 target forecast down the road. So it does look like the dollar is going to be a bit higher at some point in the near future. So we can label this, to label it properly, there is our A and then our B wave correction. But everybody will be watching the strength of this dollar. Now, so many people criticized the Federal Reserve yesterday, but hand in hand with that is the fact that the dollar has been moving to the upside. Now, yes, it got a spike yesterday because of his comments, and that didn't help. They went vertical, but we had already been gaining strength there too. So the market didn't need much, I think is my point, to cause a bit of a sell-off when the dollar is starting to gain strength like that. The other thing that we want to look at when stuff like this is going on is gold. And you can see here we've had this big move in gold. And today, specifically, we had an outside day. I'll explain that in a minute, but I wanted to show you, we had this as a case study strangle that we sent out to our subscribers with this big descending triangle pattern here. Got a little tiny bit frustrating because it took a little bit longer to break out than we wanted. Obviously, we like to see things break out sooner rather than later, but as a general rule, I've always said that the longer it takes for a pattern to form and break out, the more volatile the breakout tends to be. So in a way, you're actually rewarded for your patience as far as the amount of time that it took for this to break out. And then you can see we got this very big vertical breakout, which was a nice trade for our subscribers. Well, then gold gaps up and it forms another triangle. So we went right into another, this time symmetrical triangle, which turns out to be kind of my favorite pattern, where you have a big run up that's then followed by a consolidating symmetrical triangle. That just tends to break out. Now in this case, it broke out, gold broke out, came back down, and then the outside day today. That's not unusual action to see that kind of activity. Another triangle that we just recently sent out to our subscribers was on AutoNation. You can clearly see this symmetrical triangle, again the same type of pattern, and here was our big run up followed by the consolidating symmetrical triangle, big breakout. It would be nice if they all did that, if they broke out right away and broke out a lot. That was nice. They don't all do that. Sometimes they want to test the breakout. So in this case, GLD moved up almost immediately, came back and tested the breakout. And then we have today's bar, today being an outside day. What that means, an outside day, is that you can see we open here, there's a notch to the left, we close here, there's a notch to the right. The low of today was lower than yesterday's low, and the high of today was higher than yesterday's high. So when you have a day where the low of the day is lower and the high of the day is higher than the previous day, that's known as an outside day, and quite often that can yield an impulse move, the start of an impulse move. Now, we don't know for sure which way it's going to be. Obviously, you can make a case for the fact that it's going to move higher, but we still have this gap that hasn't been filled down here, and with everything going on, with all the news and economic turmoil, if you will, it could go to the downside as well. So we'll take a look at that next week and see which way we ended up moving. But that catches you up to date for the week, the Yin and Yang market. Hope everybody's had a great week, and we'll be back to talk to you again next week. Take care, everybody.